What is up, everyone? How's it going? Welcome to episode 5 of MSM. A very, very long time coming for this episode. Took me a while to decide what the next episode was on, but over time got some ideas and thought about some plans and some concepts that we can be covering, and especially things that I use in a day-to-day trading, right? So anything I specifically use, I want to relay onto you guys, and for me, anything that I use, I can explain it better and cover better. If I'm covering topics which I don't fully understand, then it's not worth it for me. So today's episode is going to be a slight rework on episode 1, complete new episode itself, go over some concepts from episode 1 and just sort of updating them, right? So let's get into it. 8 parts we're going to be looking at, right? We have the introduction, which is going to be talking about the aim of the episode and what I would like everyone to get out of this episode, and also a couple of tips to use for the episode, summary of episode 1 and some concept updates, identifying strong and weak structures, over-unders, which I know a lot of you already would probably know if you follow me, deviations, Monday range, momentum indicators, and sort of as just like every other episode, with these episodes I try to make them so by the end of it you can use all of the concepts and all of the information I've taken you and you can implement it all together. A lot of the stuff I teach, I try not to conflict with other things, and I like to have it all working together, and then by the end of it you can decide yourself what you are wanting to get out of the episode and what you want to implement into your own system, right? This is the point of the series, right? Is so you as a viewer and as a trader can implement that to your own trading system, right? So let's get into it. Going to be covering the introduction, the aim for the episode, and a little tip I want to go over using line charts, which I think a lot of people don't use yet. So welcome to episode, a long time coming. Episode 5 is going to be a slight rework of episode 1, as I mentioned, and the concepts that were spoken about in episode 1. Mostly because since I wrote episode 1 as a trader myself, I have improved. I've fine-tuned the concepts that I spoke about, and I want to follow up on and give any new additions and trading tools that you can be implementing, since episode 1. So episode 1 is a very entry level into trading. I think before you start this episode, you should go and watch episode 1. As always, I recommend that you go through episode 1 to 4 before you do this episode, right? Episode 4 you can potentially leave out and you can skip depending whether you're interested in using volume indicators or not. So I just really want to cover the grey areas from episode 1 and expand on and improve what I spoke on there and what I was teaching. And that's basically, the introduction and what I want to be doing, right? So the aim for the episode is to have a by the end of it, I want you to have a deeper understanding of market structure, right? Episode 1 merely covered the basics of market structure and how to use it. We were just sort of covering what structure looks like, more so than so much concepts to look at and how to define and understand different types of structure, right? So the whole point of this episode is that I believe that market structure is a concrete and a base level to day-to-day price action, right? So if you view market structure correctly and understand it well, you can base your entries off simple market structure. At the end of the day, you can simply trade off price action and what structure is doing. You don't need loads of fancy indicators and tools, and at the end of the day they help add confidence to your ideas, but market structure is a very baseline and entry level thing that I think most traders completely skip, and they should understand the core of price action before expanding onto a further system using other things. Market structure becomes more and more understandable by having screen time and markets every day. You start noticing reoccurring price action and simple setups that have consistently similar outcome, right? Something like the raccoon PA that just started as somewhat as a joke until I realized that the price action was happening consistently and mostly always having the same outcome. So basically, we're here today to get the concept of market structure connected, concreted into your strategy, and then we build on top of it, right? So the line chart is one of the most underused tools within trading or charting platform, a trading view or any charting platform, especially when trading simple things like support and resistances and market structure break, is a tool that everyone should be using to simplify and also level up precision of their trading, right? So when the line chart is switched on, right, we can see here, this is a normal candlestick chart and this is the line chart. It removes the wicks, right? So it removes the noise, and basically all we see trading is the body of the candles, where price opened and where price closed, right? It gives you a complete different perspective towards price, and in some cases this is good for the concepts we will talk about today, and we will cover, you know, the concepts, and you will understand why using line chart is better in some senses than using normal candlestick chart, right? So wicks are mostly noise at the end of the day. It simply just shows you where price attempted to go and traded to. You know, at the end of the day, the body close and opens is what matters most of the time. Depends how you trade. Wicks are still handy for swing points and structure. That's something you really need to understand, is that wicks still have use, but most of the time they are just noise, right? I want to go over the basis of understanding it, and use cases will follow later. So just want to say that during this episode there is a lot to cover. So, you know, don't feel like you have to do this whole episode in one go. You know, I've put it in parts for a reason. You can go through the parts, you can study one part, you can move on to the next part. You know, that's the whole reason I split it up. So it's not just like one full long dragging video, right? You don't have to watch the whole thing. I agree, there is a lot to take in. So the line chart sort of examples. This is, you know, on the trading view chart, you have your time, and then you have these sort of candles. Then you have Heiken Ashi candles, line chart, and then you have Renko, right? And the line chart is next to all of these. This is where you find it. Want to give you a visual idea of why I think I use the line chart, and why it's better in some cases than using standard candlestick charts. You know, the different concepts and ways to use the line chart will follow throughout the episode. However, at the moment, my only plan here is to make the idea clear, right? So as mentioned, wicks are noise. They can be a burden when looking for clear levels of interest like ranges or support or resistance, right? They can block out a lot of the noise and help you define that one area you're looking for. You know, in the first episode, I suggested that you draw your ranges based on candlestick wicks. In this case, I want to show you why I value drawing them to the body instead now, and using the line chart makes this very simple for you. So this goes back on the point of the episode of sort of reworking episode 1, and over time I've discovered potential new ways to be trading and using the tools I explained to you. So on the previous slide, we saw the range drawn out on the line chart. On BTC, I drew the range highs and range lows to the point of the line chart that peaked, drawing the range with the same concept we spoke of in episode 1, but now this time we are drawing it using a line chart instead. So, you know, we can see that we drew it to these points of the line chart, and then when you look at the normal chart, we can see that it is drawn to the bodies. And this way, in my opinion, it makes things far clearer, right? You sort of aren't looking at these wicks at the end of the day. These wicks is just where price attempted to go, but at the end of the day, we still closed above, right? Okay, here maybe we got some closes below, but at the end of the day, these wicks were just noise. We eventually traded up, and we traded towards range high again, attempted to trade above range high, rejected. End of the day, we still closed the body inside the range, right? And again here, reclaim, bounce, failed to move higher, and then we can see rejecting, holding, right? You know, now on the chart, if we draw this same range but using the wicks on those same candles, it does not have the same effect on price, nor does it give as many good opportunities for trades, right? We can still be using these wicks for trading sweeps or for our trade invalidations, but overall I highly recommend that you use wicks in future for locating range areas. So we can see here, you know, when I draw it to the wicks of the candle, okay, range highs is good, but you know, here doesn't even sweep. Here, okay, we get a deviation. Around here, we're just chopping, and again, like doesn't really give, you know, us a test here before this big move. Whereas now, if we look on the range using the body, we can see here, you know, after we get this sweep, we reclaim our range low, and then it gives us the entry. If you were waiting for the range low down here, it didn't give at all, right? Because in my opinion, this is the true range low that you want to be looking at here, the body closes. It gives you far more entries and far more options to be trading. And it's just tighter, it just looks smoother, it just looks cleaner, it's just all around better. You know, another range example here from BTC. For me, the line chart makes finding a range far easier and being able to see whether price accepts outside the area or not, right? And we can view these wicks as sweeps a lot of the time, or in some cases structure changes, right? But the body of the candles lets us focus on the specific price points where the candle opened and closes, right? So all should become clearer throughout this episode. This is just sort of using it to find a range. Like here, in my opinion, you can see how much cleaner the range is than if you were using, you know, something like this for the range. Okay, range lows is okay, but even here, like you get sort of like one tap here, you get a sweep, and it doesn't move to range lows, right? But here, you know, you've got clear range lows, right? Clear range highs, and you can see, you know, every time you're bidding here, you're getting a bounce. Every time you're selling here, you're getting a drop, right? It's just far cleaner. Oh, don't know why it does that. Again, a third example here, you know, this is talking about using the line chart for support and resistance levels. You know, it's for me, using the line chart, it helps you get precise entries. You sort of get this perfection on your entry compared to if you're using wicks. Like if you start to use the bodies, your whole trading system will become far cleaner, far simplified if you're drawing range and support and resistances with them, right? Like we can see here using the line chart, you know, we sort of have this region here, right? We sort of have this region where price is holding and then rejecting, right? And then when we come to break back through here, we're looking for a bounce here, right? But it gives nothing gives it at all, right? And mostly if you were using the wicks on this chart, you would have been looking for something like this, right? So we're holding here, but for me, that's not true support. Holding above these wicks is not true support. Our true support is here. Watching tests for the true support here for a long, but it fails, right? Whereas if you were longing these wicks up here, you would have likely got stopped out, right? Because there's no support there. The support is where the price previously traded to the bodies, you know? This is the support area, the previous SR here. Not here, not here, not here, not here. It's here, right? So I just suggest that you try it out, and then, you know, you use it, you expand on it. Yeah. You know, we're going to talk about what wicks are useful for, because at the end of the day, wicks still have use. They still have a use case in the market. Just because they're noise, it doesn't mean that we can't use them at all. You know, they're there. There's an edge in using them, so you might as well make the most of it, right? I mentioned an indication of where they're an indication where price attempted to go, but they are not all useless. There are some areas in which are still a key part in trading market structure, right? So they're useful to mark out where price needs to go to put in a new structure swing point, or even change the direction of the current trend. More on this shortly. Useful to marking where liquidity might be resting, right? So we can see on this chart, we can see that we have, 1, 2, 3 highs, which have previously to this have not been swept. I mean, even 4 highs. So we can mark that the liquidity is resting above these highs, right? Because price has not attempted to trade to this price yet. But then we can see here, in this case, if you read episode 4, we know what was going on here, right? Price comes up, it sweeps our liquidity, runs some stops, and then it's fuel for price moving lower eventually, right? That's all about in episode 4, okay? But this is what wicks are useful for. They're sometimes used to help you know where you should be placing hard stops, right? Of course, your stop loss placement is important in the market, and this can be above or below certain wicks, and your invalidation would be above or below that swing point, given you do not want price to go back there, right? So, let's say you've taken a short here on this retest here, you've taken a short. Now, your stop is likely going to be above here, because high chances that if price is going to start trading above this high, it's probably going to continue, right? We're probably flipped to a trend where we're making higher highs and higher lows, right? So that's going to be your invalidation above here. So this is what wicks are useful for. And of course, to see potential swing failure patterns, false breaks above previous structured swing highs or swing lows. And that wraps it up for part 1. Part 2, we're going to be covering a summary of episode 1 and all updates and changes since writing episode 1 to concepts. Briefly talking about uptrend and downtrend price action, trend swing points, cause and change structure and break structure recap, and updating your system for using them, right? So I know some people would be up to scratch on this, so feel free to skip through, but there's probably some things in there that I think everyone is going to get value from. So I suggest sticking around and just watching the whole episode, right? So uptrend and downtrend price action. If you feel like you do not understand basic market structure, from what I cover here, head to episode 1 where I explained it in likely a little bit more detail. I just cover the basics of this just to sort of leeway our way into this episode, because a lot of it comes down to understanding market structure. So of course, 2 types of trends. There's bullish trend where price forms higher highs and higher lows, bearish trends where price will form lower highs and lower lows, right? So an uptrend is form of higher highs and higher lows, as I just mentioned, and the higher lows are seen on the chart. They mark out as the lowest point in the swing before price made a higher high, so breaking that previous swing high. So we can see price comes down. This was the lowest point before price then put in a new swing high, right? We broke the swing high. This was the lowest point before we broke that swing high. So this becomes a swing low, right? Then we have a new swing high. Same again, price comes down, then it breaks this previous swing high. We have a new swing low, right? So your swing low can only be located once a new high is formed, meaning that price traded or attempted to trade above this previous swing high. So this is how we find our structure in a bullish trend, right? Our true structure. We use the wicks, we find the swing high, we find the swing low, right? And the most recent swing low always marks our key structure point. So this was our key structure point until this high was broken, and this becomes our new structure point until this high gets broken here. This is our new swing low, right? So what we use this key swing low for is that if we are to break below this key swing low and see a lower low formed, we can assume that price is putting in a reversal in most cases, right? We're going to cover this more shortly, right? And structure is always drawn to the wicks of the candles. So same case for this downtrend. We have a pattern of swing highs and swing lows. The structure is seen on the chart. The lower high marks out as the highest point in the swing structure before the price made a new lower low, right? So below the previous swing low. So this is our current swing low, our swing high. Once we start making a new lower low, this becomes our key structure point, right? This is the swing high. Again here, swing high, price makes a new lower low. This becomes the key structure point, because this was the highest point in price before we made a new lower low. Okay, so if it's not understanding, please go see episode 1, or just go over this section again and just read here on the left, right? Just pause the video. So the most recent swing high always marks your key structure point. If we are to break above this swing high, then we see a high formed, which we can assume this signals a trend reversal, in some cases. More on this shortly again, right? So the most previous swing high is our key structure point, right? So if price was to, for example, put in a lower low here like that, and then come up and break this high, because this is our most recent swing high, we can say that we've put in a higher high here in some cases, and we can look for a structured change in reversal and go into a bullish trend, right? So more examples here, SNX on the M30 time frame. We can see here the highest swing point before price made a lower low, right? So this is our structured high. Then again, highest swing point before price made a lower low, structured high, again. And you can see that at no point does price really break a previous swing high. Apart from here, we get this small SFP and then we break down lower, right? So we can see this is a strong bearish trend, and here we can see this is a strong bullish trend. Yeah, price is making high highs, high high, high low, right? High high, high low. This was the lowest point of price, right? Before, so between this swing high and where the new swing, where price breaks this swing high, this was the lowest point, right? So this is our structured swing low. So if price was to do something like this, break this high and come down, break this low, we've now formed a lower low. We can now look for a reversal lower, right? So going to be covering, you know, the updates to change of structure and break of structure. So now with the recap on locating swing points, which is a key part to this section. So if you still do not understand, please go back and watch episode 1, or go through and read what I just covered, because I think I explained it pretty well there. So you should be able to get up to scratch with it. Want to elaborate on the changing of structure and breaking of structure. Since the first episode, I've perfected the use of these structure changes and discovered some new methods which will give you more precise confirmation on the current trend. Some tips for using this style of trading and pinpointing when you could be expecting continuation in a move or a reversal. You know, as always, a key part of trading is not fighting the trend. You want to be focused on trading with it in most cases, apart from potential market reversals, in which this episode will be covering a lot of, right? So we can see here, break a structure, break a structure, break a structure, break a structure. This is a change of structure, right? As I just mentioned. This was the last low. This was the lowest point between our last swing high and where price broke. This was the lowest swing point, right? So then what this is our structured low. If we make a lower low, which we do here, right? We've gone from making higher lows, right, to now a lower low. We get change of structure. Likely this will now be in a bearish trend. Yeah. So the breakage structure is no different to the examples I showed you a few slides back on SNX and FTM. The breaker structure is when price is breaking its previous structured swing point in a continued trend, right? So an uptrend breaker structure, price making higher highs and higher lows. The break structure is when price puts in a new higher high. That is your boss, and you have a new swing low formed. Lowest swing point before price made a new higher high, right? As I've just been covering. Downtrend, price is making lower lows and lower highs. The break of structure is when price puts in a new lower low. That is your break of structure, and you have a new swing point formed. So in a downtrend, your most recent swing high is your area that you need to flip for trend to put in a reversal. In an uptrend, your most previous swing low is the point that price needs to break to flip the trend. So the change of structure is the one that has the most significant updates, in my opinion. The one that I feel has changed a lot for me since the episode 1, and I want to relay that on here. So the change of structure is a method or concept used to locate potential market reversals and trend direction changes in the market. Traders can use structured highs and lows, which I spoke about. So we're using the structured lows in an uptrend, structured highs in a downtrend, to identify when the trend has been broken. From there, we can look to seek market reversals and move to the opposing direction. So remember, structure is drawn to the wicks. That is the price point to be watching for the break, right? So even though the bodies are important, the structure is drawn to the wicks. So you're still looking for a break above the previous wick, right? Downtrend to an uptrend cause. So for example, if price is going down, yeah, we're looking for this is a downtrend to uptrend cause, right? We're looking for that downtrend to uptrend reversal. Your most recent swing high is the point that price needs to break above to see a market reversal. So your last swing high that led to a new swing low. If price breaks this high, then we have put in a higher high. This is a change to the trend since before we were making lower highs, right? So here, uptrend to downtrend, change of structure. So that's going to be price bullish trend to bearish trend, right? Your most recent swing low is the point that price needs to break below to see a market reversal. So your most recent swing low that led to a new swing high. If price breaks this low, then we have put in a lower low. This is the change to trend since before we're making lower lows, right? So this would be if price is making higher highs and higher lows, and it does something like this, right? The last swing low that led to a new swing high, broken. Price now makes a lower low. We've gone from making higher lows to now making a lower low. Structure is changed. Likely this does that until then we put in a reversal and then we reverse up. Yeah. So looking at SNX example that we covered earlier, we can see how this plays out. Yeah. So this is the high to break to see a market reversal. This was the most recent high that led to the break of structure, right? Yeah, the most recent high that led to a break of structure. Price ends up breaking that most recent high and we can see how the trend shifts. Yeah, market starts trading higher from there, putting in higher highs and higher lows. That is why we get the term change in structure. Sorry. Cause change of structure. Yeah, so we can see if we look back at this SNX chart, this next, you can see how it's making continuous lower highs and lower lows, and then all of a sudden, as soon as we get this change of structure, now we start trending back up, right? Structure has changed. Uptrend to downtrend. For the uptrend to downtrend example, we're going to be looking at FTM. You know, the low we are looking at is the last low that led to a new higher high, right? Price breaks below that swing low and puts in a lower low, meaning the trend has flipped into now a lower high and lower low environment rather than a higher high and higher low. Now we start to mark the highs that need to flip to break into an uptrend again, right? So then structure has changed. Now we're looking at, you know, we're in a downtrend now, right? We've gone from, now we're making lower lows, lower low here, lower low here, right? So now this was the last high that led to a new low. This is the point price now needs to break to flip to an uptrend again, okay? So now we're going to be talking about the updates. That was just a recap. So now it's going to be the updates on this. So there are a few things I'd like to comment on the break structure and change of structure and some changes I made. I want you to be familiar with SFPs. We've covered them before, but this is a swing failure pattern. I covered these in episode 3 of the MSM course, so I just suggest you go and check them out if you do not know what they are. To summarize, They are when price sweeps a key structured swing high or swing low before moving away from that area. Usually we trap breakout traders in the wicks on that sweep above as well, which ends up getting them to force close once price starts moving away from that entry. This adds fuel to the move point. So, you know, we can see that this is a potential SFP. Price comes up, SFPs, and now we're moving lower, right? Or it could be a break of structure, right? So this is what brings me onto this section. Is this a break of structure or an SFP? So SFPs can easily be mistaken for a break of structure given they look exactly the same. With a strong SFP above a key swing point, it usually leads to the start of price trending the other direction. And there's a couple of ways we can identify and watch out for these setups to minimize losses and getting caught in a trend reversal when you could potentially be thinking that it's going to be a break of structure, but instead it's a swing failure pattern. Want to be clear, an SFP still counts as a break of structure in trend, meaning the previous swing point that led to the break of structure the break is your new structure still. So by that I mean here, whether this was an SFP or not, whether this was an SFP or not, our low here still counts as structure, okay? Important to know. So there's a few ways to identify whether this is an SFP or a break of structure and which direction price may move from here. So SFPs tend to just be a wick and will not close the body above a previous high. If the break is strong and we have some body closes above that previous swing point, then likely the trend will continue to be strong and it's not a swing failure pattern. So only look for body closes. So look for body closes for a break of structure. Does not have to be a body, but usually is a good sign if it gets a body close. Like SFPs tend to only be wicks above previous swing points. SFPs usually give a harsh rejection after sweeping that swing point, right? So, you know, if we came up, so, you know, we're looking at a list here, right? Price comes up, is it a body close? No, it's not. Okay, potential that this is a swing failure pattern. Price comes down, unsure on, you know, if it has a bad rejection, likely then it could be an SFP if price rejects, okay? If unsure on the break, it's best to wait and see how we react at the order block and imbalance that led to the move, right? So we can see price comes down, good reaction from the order block. No, there was pretty poor reaction from the order block. Okay, best to see how we react at the structured low. So now we're looking to see how we react at the structured low, right? We're looking to see if we get a change of structure here or whether we sweep and then continue higher. The low does not hold, the structure breaks, highly likely this was an SFP. Now we're looking for a market reversal. We can see here what happened after this, right? Price comes up, SFP. So what I'm sort of covering here is I'm giving you a checklist to not get caught in the idea that we're in an uptrend here. Yeah. I'm giving you the tips to not get caught in this being a break of structure. And now you're looking for, you know, now you're longing here because you think price is now going to put in another higher high, right? Here. What we're doing here is we're reviewing whether this is an SFP or a break of structure. And I've sort of given you a checklist here to the ways you want to be looking at that. Eventually, turns out that it was an SFP, swing failure pattern. Price attempted to trade above this high, but failed. Eventually, we get the change of structure and the price reversal. You know, another example here on Litecoin, but the opposing side, we can see that price comes down and sweeps our structured low here. Now to identify if it is an SFP or if the trend will continue, we see a harsh wick and bounce, right? So we can see here, price comes up, pretty harsh wick, no body close at all, and there's a pretty strong bounce. We see a harsh wick and bounce. Price eventually moves up and forms a change of structure to the upside, confirming this was an SFP. Then the reversal plays out. Yep. Another example here, Bitcoin H4 time frame. Price comes up, we see a strong wick. Is there a body close? No. Highly likely that this could be an SFP. So now we're looking for the reaction at the order block. Price comes down, it tests the order block, gives a pretty decent reaction. Highly likely this was a break of structure, as well as a swing failure pattern. It was a break of structure, and price will continue up. Okay, and then we can see this is what it does here. It continues up, and we put in a new break of structure here. We put in another higher high. So I think this is the last section in part 2, but this is the change of structure updates, which is the more important part to me, and I think the more important part to most people here about how to identify a true change of structure or not. So I tried to find areas where I could develop and maximize how valid a change of structure is and what it actually entails, deciding what gives a change of structure or not. And there was one thing that I started using, and that was the body closes. So only using body closes for a change of structure. This confirms a strong move and price truly breaking and changing the structure of that current trend. So we're looking for a structure change above or below that previous key swing point, right? This also invalidates the possibility of a swing failure pattern on previous swing points, which is just a failed attempt at changing the trend, right? I noticed a lot of times, say if we were in a downtrend and price made a higher high but just a wick, we would still continue to trade down. You know, we SFP'd this high, for example, here, okay? We can see here, price, lower low, lower low, lower low, lower high, right? Lower low, lower high. This is our current structured high. Price comes up, attempts to break, but if we just SFP this high. So what we've done, we've attempted to break the structured high to continue towards, you know, our next structured high. But we can see we just SFP'd, and then you see the drastic sell-off we get from there. It's a failed attempt at breaking structure, in my opinion. If this was a body close, then maybe we could be looking to trade higher. So this is a Bitcoin M30 chart. Now we come down here and we can see price has, you know, the first body close we get from price on BTC here. Price has a body close above our most recent structured high. This was the last high here that led to a new lower low, right? Lower low, lower low. Lower high, lower high. Okay, now price makes a higher high. Price closed the body above, and then we see the reversal we get from price action. You know, since we see a strong break in structure marked with the body close above our previous structured high, we see price start to put in a reversal, right? This is a very important price part of this concept for me here. Another example, this is not specifically something you could trade, but it's definitely something you could you can look at and understand what I'm talking about here, right? So here, body close, right? Price now you know, downtrend, body close, price now start making higher high, body close, price now start making lower low, price comes up, attempts, SFPs, continues in its downtrend, price comes up, body close, starts making higher highs again, right? Very important to use the body close only for change of structure and not wicks. Again here, this is the high that price needs to break to flip the trend. Right, the last high that led to a new lower low, right? Price is making higher highs here and higher lows, break structure. Everything that is happening here is internal structure, right? This is our structured low because it led to a new higher high, right? But it's not a cost, it's an SFP because there's no body. And you can see after that SFP what happens. These examples are best if you pause the video and you just review them yourself rather than me sitting and rambling on about them. And the third example here, price wicks our previous structured low, attempting to break down and flip the trend after we see the SFP. We see a change of structure play out, right? Structure here, high, low, high, 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 low, high, high. This is the lowest point between this high and this high that we're looking to break. Yeah. So this is the structure low we need to break, but price just wicks. It doesn't get a body close. So for me, this has not invalidated the trend. The trend to me still says up, right? So what happens is price comes in, we get a sweep, not a change of structure. Internally, we get a change of structure, and then we continue up. Okay. I promise you, there was whether you don't understand it now or not, there's a lot of value in what I have just covered here. So please go back, review it again. I know sometimes it can be hard to understand vocabulary, so it's best if you just go back and you review it yourself. You understand the concepts yourself. There's more than enough information here to cover, but the point of this, there's a lot of information here which are little tips and tricks to trading market structure, but the point here is that you should use body closes for change of structure, right? So we're just going to recap this part here. Focus on the highest structure clear to you possible, which is your external structure. Remember, external versus internal. I spoke about this in episode 1. Play both ways, but most importantly, trade with the trend and focus on understanding which trend it is going to use, which way the trend is going using the tips I've shown you. Draw structure to wicks. Focus on trying to avoid SFPs and being confident that the structure was actually broken rather than just swept. Cause is formed by body close, the other side of a key structured swing point. Also a key point here, if we have an SFP on a previous structured swing point, then the SFP wick becomes the new swing point of the structure, right? See next page, for example. So for example, for when we were just talking about the trade with the uptrend, I don't know why it keeps doing this. Here, right? This was a SFP, not a change of structure. We had no body close. This SFP low becomes the key swing point, not this one, right? Meaning it was the lowest point. It was the lowest point before price made a new higher high. This is the low to break for structure to change, which eventually it does here. And that just about covers it for part 2. Welcome to part 3, where we will be talking about identifying strong versus weak structure using price action. This will be covering using structured highs and lows as support and resistance, and types of market reversals we can see. So using these to your advantage to identify strong performers in the market and deciding what you want to be trading. So specifically going to be talking about price action here. We will cover some analysis on basic price action to help identify when price may be strong or weak. This will include the way the market may react to swing points, support, resistance levels, and some other things. So the only thing about this section is that it might conflict some concepts we have discussed previously with using supply and demand, but I try to make things go as hand in hand as possible and sort of combine together as much as possible, but there may be some parts in this where it might conflict with our supply and demand episode, whereas we haven't really had that before, in my opinion, in MSM. So I still want to go over the basics, understanding price action, and hopefully by the end of this you will decide whether or not it was of use to your style or not. Either way, there'll be some parts that are useful to anyone as a trader in this market. As I said at the start of the episode, understanding basic price action is a key part to trading. Watching how price action moves over time can be very beneficial to you as a trader, and over time you will most definitely be able to pick up things that you have not noticed before just from watching price action unfold. It is the support to build all your trading methods on top of, in my opinion. And we'll be talking about using line chart in this episode. It comes in handy. given this is the best way to identify true structure, support and resistance level as we spoke of, and we're going to be talking about how to identify strong support and resistance levels using key structured areas. So using structured highs and lows, I've briefly already covered using the line chart for finding SR levels, range highs and key points. But where you would want to see and where you would want to see a price reverse from. Another way you can be using this line chart is to identify a structure where you can potentially be taking trades from. So, holding above previous swing highs or swing lows can be a good way to trade continuation in a market. The concept on the right is something I've been looking out for a lot lately. In previous episodes, I've taught you to sort of focus on waiting for a pullback into an order block, of the break of structure, the order block that led to the break of structure, but sometimes this doesn't always give, especially if the structure is showing strength by flipping key previous structured levels for new SR areas. Okay, so we can see here, if let's say this is the line chart, this is the structured body high of our swing high. We can see that price breaks it, retest the previous structured high, and we see a bounce. Given price puts in a new high there, we can say that this area is strong, right? This is a strong low. If you remember from our episode where we talk about weak lows and weak highs, if we're in an uptrend like this, and this low here fails to sort of make a new higher high and sort of rejects from this previous high, likely this is called a weak low. So price will come down to sweep this low maybe before going higher, right? If it's a strong low, these are strong lows, okay? This is a strong low in an uptrend because price bounced and made a new high. This low was strong, whereas this low was weak because it done this, weak low here, yeah? And this is a weak, and this is a strong low, okay? So just from price retesting this area and then making a new higher high from this structure, we can say that, price is strong. We're looking for continuation from this next high low, given we had already seen a bounce from our retest. So the example below is a chart that you should be familiar with since we've already covered this price action on previous slides, but this time we're looking for a different approach to structure. We can still use the same structured highs as before. So, our bullish and bearish trend, we have to remember our structure that we've already discussed, right? But this time we're marking them as SR levels. If we compare to the first attempt at holding above the first structured high to the concept I showed you on the prior page, we can see that the structure is not showing much strength. So what I mean by that is, this is our structured high, right? We can see that price sort of comes up here, yeah? Ignore all of this, for now, yeah, right? Price comes up. On the retest, we failed to put in a new high, right? We failed to put in a new high. Instead, we just sort of bounce again, and then we get, this looks weak, right? It kind of looks like quite weak price action. And eventually we break down and we move lower, right? So bad reaction from our previous structured high, does not show signs of continuation. Same case goes for the new higher high that we printed. We attempt to break this high twice, but failed twice. Eventually price looks to sell off lower. So again, right, remembering our structure, low, right, higher, low, low, high, sorry, right, high, low, higher, low, right, this is a higher low, high. Looking to hold the previous structured high area here as support, but fails. Likely we're going to trade down, maybe test some order block below. In this case, we sweep this low and then we move higher, right? Then we get low, high, right? And again, this time, our previous structured swing high, twice we fail to accept above there, and then we reject and we continue to sell off, right? Likely if price was strong and looking for momentum to continue, it would have broken and hold above this previous high, right? So in this example here, we can see prices forming higher highs and higher lows, right? Standard uptrend. On top of that, since we broke our previous structured high, we have continued to hold above this level, right? So this is our previous structured high level, right? You know, even though this is our swing high, as I mentioned, we're going to use the body of the candle. We're going to use the line chart to identify a level. So using the line chart, we can identify this is our level, right? The body of the previous structure high acts as a support area at first, right? So now we're looking for some sort of trigger to show us strength and potential continuation. So ideally on this, we would be looking for price to, you know, we make a new high, come down, bounce. Now we're looking for continuation higher, ideally, right? Because we held this structured high, but instead, you know, we come down and we make lower lows internally. We start to make lower lows here, and still yet we're failing to break above. Okay, price eventually breaks the previous high level, right? Fails to give any sort of continuation, likely telling us that momentum has shifted as we fail to hold there, and we can expect downside. So now we eye this previous structure level as resistance. Okay, we can see here, you know, we failed to hold here. Likely now, you know, market dynamic has changed. We're probably going to come up here to trade lower, maybe to test this low, right? Structure is not strong. And this is when it gets to the part where I talk about how it can be conflicting with demand, right? Because you could be looking to long demand down here. On the retest of that structured level, we see a break lower, right? Here is when we sometimes have to forget that we do not always need a change of structure to look for a reversal, which is why I mentioned there could be some confliction in these methods. The change of structure does not actually form until after this move had happened. This is an example of another way of potentially seeing when structure is becoming weak, failing to hold previous highs can be bearish, and vice versa from upside, right? So we failed to hold this level here. It keeps doing that. I'm sorry. I need to stop pressing escape twice. I figured out why I was doing that. We can see here, likely if price action was strong, we flip this structured high, you know, we come down. Likely we would have retested this sort of cluster area here and then continued, but instead we failed. And then now this previous resistance that was attempted to flip for support is resistance again. Price rolls over, right? And this obviously looks familiar to the over-under setup that we will be talking about later, if you guys know what that is. So this example clearly shows my case in point what you want to be seeing in a strong trend. Again, this chart may be familiar as we studied it earlier, but what we can see is that every time we make a new lower low, as in a break of structure marked with these red lows, the body of that structured low acts as a reversal point for price when we revisit that area after forming the new lower low. You can see how consistently the previous structured low, the body of the candle, acts as a resistance and reversal for price, right? The trend remains bearish since we are forming the strong structure and we have yet to see a change of structure. You know, we're playing with the trend to prove analysis, and you see what I mean. So these are our lows, right? These are structured lows. These are lower lows. These are our key points of interest. But if we look at the body as well, the bodies of these structured lows, we can see every time these bodies are acting as a reversal point, right? Every time price bounces, you know, these are our lower highs being formed as well. These are all our lower highs being formed, right? The body of our lower low is acting as a reversal point for price. We're struggling to break above. Again here, struggling to break above. That's a sign of a strong trend. Yep. Final example here, following on to the prior slide, we can see how price forms a change of structure, and on top of this we break above the last bearish swing high structure and hold there. Eventually we get a bounce and reclaim another previous swing high structure also. This is a sign of strong reversal when we break even back above previous highs, strong momentum flip, and sign to get long, right? So we can see, you know, this is the spot we were talking about on the last slide. The bodies are acting as reversal point here, reversal point, reversal point, reversal point, here, reversal point. But on this bounce, we get a change of structure, and also we break these lower high trends we're getting stuck in, right? We break this lower high trend we're getting stuck in. Instead, we get a change of structure. We break the last high that led to a new lower low, but we also flip above the bodies of the candles, right? This is a good sign of reversal, yeah? On top of this, we have a strong V-shaped reversal, which we are going to cover shortly, right? We're going to go over V-shaped reversals, but this is a great setup. If you see this happen, this is the place to be taken along. On the retest, we get a change of structure, but not only that, we get this, we break above this high, right? So we break up, instead of getting stuck below these lows, we break above the highs. There's a sign of strength there. And then you can see how price bounces. Again, we hold above these highs that previously acted as resistance. Again, here, hold above these highs that previously acted as resistance, right? Once you start noticing this, and like, this is what I mean by the confliction. Realistically, we would have been waiting for this order block here, right, to get filled. This was the order block that led to the strong break that broke structure, but we never got filled here. So we just bid the highs in this case, right? We bid the bodies of the highs because this is where the strength is. This level is holding. So we're going to be talking about market reversals now, identifying how to see a strong or weak reversal. So noticing strength in price versus price action versus weakness is a game changer when it comes down to choosing what you want to be long or shorting throughout the day, right? If you're looking for longs, obviously you want to be trading the strongest gainer in the market, and when it comes to shorting, you want to be shorting the weakness, like the weakest thing, right? You don't want to be looking to short the top gainer of the day unless you have some sort of edge and triggers. You're using flow and the top gainer is showing sign of tops. Of course, that's a reason to do it. But the majority of the time, if something is trending, especially in our current conditions, you know, this sideways chop market is probably going to continue to trade higher. You don't want to be looking to short that. You want to be looking to long it, right? There's no point chasing alts when there's next to no strength for a bounce, right? Or a move higher when it simply is not showing you strength. I'm sure we've all been there when we've seen things bouncing multiple percentages whilst the alt you chose continues to trade sideways or does half the percent what others are doing, right? Everyone's been there. One of the ways of noticing strength in the market is how I showed you on the previous structured highs and lows, you know, trading with the trend, using methods and knowing which way you want to be trading on a coin, picking what is strong. Another way to identify strength or weaknesses is watching how things recover from sell-offs and how price reverses after a strong sell-off. It's very telling to what may be strong or weaker. And, you know, I'm sure you've seen a lot of traders within Walsh Group, in Wealth Group using, you know, discussing V-shaped reversals, and that's what we're going to be discussing today in this price action. So V-shaped reversals. V-shaped reversals refer to a pattern that occurs indicating a sudden change in direction of a specific asset's price. Is named V-shaped due to the clear similarity between the letter V when plotted on a chart. A V-shaped reversal typically occurs after price starts to bottom, you know, after a downtrend or even a sharp drop. The pattern is usually seen following by a sharp decline followed by an equally sharp and quick recovery as seen here, right? You drop down and then we sort of get this V-shaped bounce back up, forming the noticeable V-shape on the chart. Yeah, we can interpret a V-shape reversal as a potential sign for a change in trend from bearish to bullish. It suggests that the selling pressure has exhausted and buyers have taken control, leading to a rapid recovery in prices. You know, or even a sign that shorts are getting squeezed out, which leads to more fuel for the V-shape move back up. You know, if we get some bottom shorters, it adds fuel for us to just V-shape back up. And, you know, at the end of the day, using order flow is a great tool to trading. The pattern is seen as a strong bullish signal and may indicate an end of a downtrend and the beginning of an uptrend, depending on where we V-shape to, right? So this is the reason for covering this price action today is discussing what V-shape is strong and what is not, right? You know, it's important to know that not all V-shaped recoveries result in a continued uptrend, right? Sometimes the price may retest the previous structured low or consolidate before continue higher. using our structure as a strong signal to decipher whether the move can continue or the downtrend is still in play. This will be a decider of what is strong and what is not, and this will be a key point in deciding what you want to be trading. Okay. Below I've drawn out some quick concepts to give you an idea of how you want to see price react after sharp sell-offs. Simple ways to identify a strong recovery versus weak. Okay, so this is a good sign of recovery. Recovers back to the base of the original structure it broke down from, right? Again, not using the wicks, okay? Very important. We're using body candles here. This is why the line chart is very important. We don't care what the wicks are doing at the end of the day. The wicks are noise unless we're using them for structure and identifying structure breaks. Other than that, we use the body close, and that's where we draw the baseline to. A very good recovery, you know, is that we recover back above the highs where we break down from. This is a very strong recovery. A bad recovery fails to reclaim the area in which it originally broke down from, right? And a very bad recovery is usually we fail to even test the area we broke down from. Usually a lower structure area will act as that reversal point. So some examples that we have already covered previously, but using the V-shape we can understand and implement them in, you know, all concepts. And this is what I mean about finding setups that all work together. And then once you have, you know, all of these concepts adding together and all of them are showing the same reason for taking a long or a short, these are A+ setups. You know, these are the ones you want to be taking, right? Price is trading down. Yep, lower highs and lower lows. We see a sharp decline in the price and it drops rapidly. This can be due to negative news, market volatility, or other factors, right? Price starts to find an area where it can potentially bottom. Price starts recovering back towards the area it broke down from. Sometimes it may bounce in the middle of nowhere, but likely there'll be some sort of sweep or support area that we decline into that can potentially see a reversal from. Price ends up eventually trading back above the highs we break down from. And this is a very good sign. This is the place you want to be taking along, right? If you're not already long from down here for whatever reasons you have, here is when you're going to be looking. We've reclaimed the highs we V-shaped, and we V-shaped back up but above it. Now if we look at this chart here, right, how similar this looks, yeah? And then you can see we take the long and you target basically all of these highs, and you see how with a V-shaped reversal, with a cos, right, we can then target, you know, all of these highs, and then we TP up here, okay? And the invalidation would be just back below the base area where we originally broke down from. Given if we trade back below there, likely this reclaim was not actually strong and we would see price trade lower again. Another example here, price sees a sharp drop, breaks back up, but you can see rejects from the previous structured low area. Meanwhile, the other alt flipped above. Okay, these two examples are timestamped to the exact same time drop and time of the reversal. Okay, but we can compare the two and easily notice which one we want to be focusing on, right? So it's key to understand and to bid the strength, right? So we can see here in our previous example, we reclaimed the highs, but in this alt, right, which we're going to cover in a second, we reject from the lows. This is the place where you can start to notice strength from the weakness from bounces, okay? We can compare these two alts from that bounce on the line chart, and we can clearly see SNX had the stronger structure. And look how well it outperformed to Ocean on that bounce, right? Simply because of that, simply because of the way we reacted after the V shape, right? We want to be chasing SNX because it's showing us the strength. We don't want to be chasing Ocean. There's nothing there, right? Market is all beta at the end of the day. Everything will likely trade the same as each other, but some things are going to offer a better return on your money than others. Look how Ocean trades against Ocean X here. Almost exactly the same price action, but SNX is performing far better, right? We can find these strong performers by identifying strong structure and focusing on what I've been talking about, okay? And it also comes down to using spaghetti chart in these drops and seeing what's strong, and then you would look to bid the same way, right? You want to use spaghetti chart. JD has got a bunch of spaghetti analysis in its corner. He always talks about it, so I suggest go there to understand how to use it. So we can compare these two online. So we've done that, haven't we? Example 3. There's never always a case of price sending higher from these V-shaped reversals. Nothing is 100% confirmed in this market. It's always important to see a test at that area and if it is showing signs of continuation. Okay, you can see on, for example, on the right here, after showing a strong V-shaped back up, we broke above our previous structured high, but we failed to hold at that area. Yeah, didn't even give a sign of a bounce. Okay, shows no signs of a bounce and breaks straight through the previous high. Okay, rejects from the previous high, weak price action as we covered earlier, right? Likely if price action was strong on this break above, we would have held, but instead falls back through. Now we're looking for the reversal here. Okay, resistance, failed to act as support, likely is going to act as resistance again. Okay, this can be a great trade in a solid over under setup, which is coming up in our next part. So quick recap on part 3. Use swing structure concepts like breaker structure and changer structure to assist you in these SR concepts, both used with confluence of each other for great addition. Yeah, focus on strength after big sell-offs using the methods I've showed you. Use the line chart to identify key structured highs and structured low level as SR levels. Understand when the trend is strong and when it is not strong. Trade stronger than weakened coins. Sounds easy enough, but most get lost not doing this. Do not force things that are not there. Go and look at these sort of setups yourself. Get used to identifying what you should and should not be bidding after a sell-off. And that, I think that's pretty much sums it up for part 3. Go back, have a look at these examples again, go through them yourself and understand what we are going through here before we moving on to the next section. Part 4 of episode 5, MSM. Over-unders, something that I think if you follow me, you know I use a lot and are one of my most favorite price action patterns, concepts, whatever you would like to call them. We're going to be talking about over-unders, a bit of a bonus section on failed auctions and what a failed auction is. As always, I talk about this a lot and the reason for market moving between a balanced and an imbalanced market, right? I'm not going to go into too deep of a detail, but if you are interested, you can go to episode 4 where I cover this section, and I talk about value areas and why the market moves, why it does, and if you're interested in that sort of thing, you know, what they are, why they're helpful, and how to use this with, you know, price action that we've already discussed. So failed auction, you know, deviations and over-unders fall into the same sort of category. I don't want to go into too much of the detail why, but I just want to re-jog your memory. And like a failed auction is predominantly used in term and order flow, especially with market profile. But if you translate it onto standard price action, we have a similar concept behind the idea of what we call a deviation in day-to-day price action, and it is usually a failed attempt to break into a trending or trading environment outside of balance, right? So usually what a deviation is which we'll get into shortly, but you have a break above a balance or below a balance. If it fails and it breaks back into that balance, then what we have is a failed auction, right? Because an auction is a process where we have between buyers and sellers, they come together to determine the price of the asset. If price moves higher, then likely we could say buyers are in control. Price goes down, sellers are in control. You know, a failed auction occurs when there are not enough buyers or sellers to complete a trade at a given price. So usually it's a sign of exhaustion, right? Which can happen at tops and bottoms of price action. And it's why we have deviations, right? It's usually a sign of the price attempting to break out of a range. And we deviate back inside that range, given price exhausted, buyers have failed to push price above, sellers have failed to push price lower. Then what you have is a complete market reversal. You can also click the link down here if you have the link to the episode, and you can read on the auction market theory, which I talk about in another episode, which I highly recommend. So where do where do these failed auctions and over-unders happen, right? So deviations, over-unders sort of fit into the same category. So this goes for both, whereas for this episode, for this part here, we're just talking about over-unders, but talking about where they happen and why they happen is for both of these. So find them on all time frames, any chart. Most likely see these occur specifically in a few places. Above and below ranges, ideally a pretty high time frame. It can be any time frame, but the higher the time frame, the more chance once we deviate back below or above that level, we can expect a strong reversal. So above key support and resistance levels, above value row highs and lows, above VWAP bands or below prior bands, more consistent, above or below key structured swing highs or lows. As I mentioned on the previous slide, failed auction can be a good sign of a reversal and exhaustion in the attempted move. We can also use order flow to see whether potentially we have trap traders attempting to play the breakout or breakdown. So quick recap on what we just covered. Failed attempt at breaking into new prices, failed attempt for price to move into a trend market or continued direction, show signs of exhaustion from one side, only confirmed the deviation once price moves back below the point of breakout or breakdown. Better if breakout traders positions end up being offside. Trap positions can be found almost anywhere, as long as the level that has been deviated was previously a significant price point for price. So this is an example of a failed auction, right, or a deviation. So we can see here that, clearly a significant price point for ETH here. We can see, range highs on ETH. Price attempts to break above this significant price point here, fails to flip the price point, the range high area, breaks back below into the range, shows a clear deviation on the retest. We can expect price to move lower, right? So what we have is break up, failed attempt at breaking the range, moves back in, and now we're back into range environment. This slide is actually meant to be back here with the failed auctions just after this slide, so apologies for that. And this image is looking at the order flow side of things. Buyers initially break the resistance, right? We can see an increase in CVD, open interest, and price. But once we break this resistance, so this 1986 level is this level here, this high time frame range highs, we can see that once we break it, there's no follow through or interest in buyers, right? We can see open interest drops, CVD just moves sideways, and eventually once we break back below into this range, we move lower. So over-unders, what are they? We got the Y part out of the way so we can get a bit of understanding why the following examples may happen. We can move on to how we can potentially trade them, right? What an over-under usually is almost like a head and shoulders pattern, right? They work for both ways, so it's a reversal pattern. So if we flip this upside down, it would work the same way as if we were trying to find a bottom as we were to try and find a top. So they are a strong price action pattern that tend to have a high hit rate in playing out. You also may recognize this PA as an example from earlier in part 3 when we looked at this setup. The price action pattern that uses structured highs and lows. Predominantly, given we have already covered using structured highs and lows as SR levels, we have somewhat an idea of how these play out. So best to look for these setups at valid points of interest, right? So rather than just in the middle of nowhere, we want to have a reason for there to be a reversal at this certain price point. So we would want, like, say this is a daily order block here. What we're looking for is a move into the daily order block. If we get this set up, right, if we have this left shoulder, this head, and then this right shoulder, usually it means is topping out. But you want to be looking for these setups at a valid point of interest. You don't want to be looking for these setups in the middle of no man's land. You're just setting up for failure. So also want to add that it's usually structure. So it would be one high. So this would be one swing high. Then we would deviate above that swing high, and then retest it and then sell off. And the straight same would work for the downside, right? So it'd be, you know, something like this. Yeah. Something like that. Why are they helpful? They tell me one thing usually, which is that price attempted to trade higher or lower from the other side of a key area but failed. You know, if we use this price action pattern also with the idea of finding structured reversals, change of structure, then it becomes a very strong setup and trading concept. As I said, reversal price action pattern, and this is what makes them helpful in noticing when to start trading the other direction or even get out of your current trade. Should be noted that structure does not need to form a change of structure, but to be valid, but you can front run structure breaks if this price action pattern breaks out. So you don't actually need a change of structure, but you can take it. Also gives a bit of validation in your trade. So, you know, if we break above this previous high, we can say that there's nothing to say that price wants to bounce higher here and take our stop. But once we get this deviation back below, we can be confident that price is likely topped out here temporarily. Once you break down this previous high, we can be confident, you know, that price does not need to test higher again, stop above, you know, there, and we have a not much easier validation than just trying to short blindly into previous SR, right? So first example here, we can see price comes down, makes a baseline, bounces, lower low, lower low, okay? Then what we get, you know, we have a rejection from this base area. As we mentioned earlier, this is strong continuation. We break down. On a break back up, not only do we get a change of structure, we also break back above this level. Yeah, we break back above a previous low that rejected. So, you know, we're looking to, you know, it's a sign of strength here. We're trading above this high. We've got a change of structure and we're back above this previous low. So we're looking for our right shoulder here, right? So we got our left shoulder, our head, we get our right shoulder, we get this test into our level using, as I've mentioned, the bodies of the candle. We take the long and you see the reaction we can get. Then what we get is this over under setup, right? You get this left shoulder, you get this head, you get this right shoulder. Then what you have is this deviation below this area. This was a failed break at moving lower. We get this reversal set up and then we move higher. This is what we call an over under. Again, another example here, you know, there's no time limit on over unders and how long it should take for an over under to play out. These happen on all time frames and price can revisit a previous high weeks later and the pattern can pay out if you are looking for it. Okay, so we can see here price deviated above a previous structured high almost 8 days after it was formed. Here it held this area at first. We get this bounce, like I said, that's usually a sign of strength, but evidently starts closing below. Okay, on top of that we get a change of structure. This is the sign of reversal. Now we're looking for a move like this, right? We're looking for this right shoulder. So we have the left shoulder, we have the head, now we're looking for the right shoulder. Price comes up, tests our point of interest. We take a short if we have on the lower time frame some triggers for a short, which this chart did on the lower time frame. This chart had some triggers for a short on the lower time frame. We're looking for a reversal setup. So just like we're looking on the higher time frame, we're looking for reversals on the lower time frame, and you see the reaction we get. And that is again another over under setup, right? High, head, high, like that. Yeah. We deviated the previous structured high, failed to hold above, likely structure is now weak. As I mentioned, you do not have to have a confirmed change of structure break. These over-unders can play out without them. This is an example on Sol H2 chart. We can see we got our left shoulder and our head. No change of structure yet, but given the break back below our previous structured high, we can still look for potential shorts on this retest of the area. We have a point of interest below, yeah. We can also see unswept lows below, sharper liquid move to the upside as well. Price comes up, makes the right shoulder, sells off lower, right? Another great example of an over under. So recap on over-unders. Make sure that you're using this setup at a valid point of interest. Make sure that there is a reason for price to be put in a reversal there. That'd be an order block, high time frame, SR level, or market imbalance. You do not always need a change of structure. Good sign of one side exhausting, market will look to reverse the other direction. Better used in order flow, right? Work on all time frames and most charts. Important to remember to look at the higher time frame, even though you do not need to change structure to play out. Do not get caught in trying to fight the trend. I had this on ETH the other day. I tried to take a long on the lower time frame, but did not notice on the higher time frame that we had an over-under setup forming, a bearish over-under setup, and I was just longing internally into a bearish over-under setup, right? Make sure you're using strong structured highs and lows. Not only this, but you're not only just not any random high or low, right? Use the bodies of the structure as I have already covered. Best to use over-under with other confluences like momentum indicators for divergences, which we are going to cover later on. And that sums up part 4, over-unders. Part 5, deviations. Bit of a continuation on our last part 4, but deviations are, we're going to be talking about what they are and why they're helpful and how to use this price action with examples. Over-unders are, very similar to a deviation and what they look like and how they act, so it saves some time explaining that. But one key difference between an over-under to a deviation is that an over-under form above a previous structured swing point, right? So just one individual, usually just one individual swing high or swing low, whereas a deviation still forms above or below a swing point, but usually ones that have been tested multiple times, so something like a range high or a range low or key SR levels instead of a singular structured level. Deviations have a far higher hit rate putting in a reversal, given they end up deviating an area that has been tested multiple times. On a break of a level that has been tested multiple times, you would expect price to continue. Failure to do so gives us a clear failed auction once we moved back below the initial breaking point and previous area of price reversal. Just like over-unders, they usually indicate a sign of exhaustion in a market. Exhaustion being that one side failed to break price, so buyers have attempted to push price up here. We failed, likely buyers are exhausted, and once we fall back inside our balance, we likely move to the other side of balance, right? Standard value area and auction market theory concepts that we spoke about in episode 4. This leads me to a deviation back below its breaking point. You would take the same setup star as you would an over-under, right? So this is an example. We can see on the daily chart of SNX clear support area, right? SNX tested this area 4 times, and then on the the 5th time we break back down through the support area, and we sweep, whatever low this is, maybe a yearly low, we sweep this yearly low. We can see after that SFP, price ends up starting to bounce, right? Price bounces from the SFP and the daily chart puts in a change of structure. So not only are we sweeping below this support, eventually we get this change of structure. So now we're kind of interested in a reversal. Like, is price gonna put in a reversal here, right? We're interested in seeing what's gonna happen. On top of that, we're looking at reclaiming this strong pre-daily level, right? So we move into the lower time frame now to sort of watch the flip of the previous support area, and the daily chart has put in a change of structure, so we can expect price to put in a reversal from here. On the test of that area, we look to take a position with the invalidation below that with that daily area. Given if we fail to bounce from here, likely the reclaim was not successful. You can see here what happens, right? Look at the drastic move we get from here. It's a massive move off SNX just because we deviated such a significant level 1, 2, 3, 4 times on the we deviate it after tapping the 5th time, and then on that strong reclaim we can see consolidation, and then boom, price moves higher, right? This is the power of deviations, especially the other side of such significant levels. The thing is with deviations, we always hope for the perfect setup, and once we break back / above / below the initial point of the move, we want to get a retest on that level, right? You know, we want to get a test here, but price does not always give us this level. There's not many ways around this, and a lot of time you can your trade can play out without you actually getting filled. You know, we've all been there before. Sometimes you have to force yourself to take a risk and chase price if you do not think it will come back to your desired level, right? Take an example from BTC here where, you know, we were ranging and we got this strong deviation. Again, talking about price action earlier, price comes down, tests, but fails to break above a new high. Likely this is a weak low. And what does the weak low mean? It's going to get swept. Then on the sweep, we don't reclaim. High chance we're going to look to, you know, we're going to look to break down. So, you know, we want to retest this level, big deviation above the range highs. Likely we are going to have a large sell-off lower given the significance of this daily range, right? You know, price ends up leaving without the retest or the chance of filling us. It has happened to everyone before, but chasing price down is the only answer to this at this point, right? Again, another super clean example of a deviation here on the inch chart. We can see that this support area previously held multiple times, right? 1, 2, 3, 4, 5, 6 times we bounced from the support area. On the 7th time, price attempted to trade below the support area level. We end up deviating on this reclaim, failed to break lower, reclaims the original breaking point. So this is the original breaking point. We reclaim that area. Look at the bounce we get from it, right? So what happens is we get this failed auction below our level, and then price reclaims and moves higher. Deviations give a really good outlook on the market. Price attempted to go to X, you know, whatever point that may be, but failed, and now reversing back the other side of its breaking point. Likely it will continue in that direction. Okay. You know, just added this one in late because I actually traded this myself the other day, but it was a nice example. Using Lido on the M30 chart, we can see sort of had this range low area here and range high. We deviated the range low. On the reclaim, look for a long towards the range high, right? Standard range price action playing. Reclaim range low, deviates a range high. Price ended up deviating range lows. You know, range place a target would be moved towards range highs. Price moves towards range highs and sort of hits our TP area and also puts in an SFP above a previous structured high. Yeah. Now, because we broke this range high level, we can potentially looking for a retest and then a move higher. But instead, you know, we deviate then the range highs. We get a deviation this high side. We break back into the range. We can be looking for a short towards range low, and this eventually did go towards range low in the end, simply because we SFP'd this high. We deviated on the reclaim back inside the range, right? So what this is telling us is both sides now attempted to break down, reclaimed, move to range high, attempted to break out, reclaim, move down to range low, right? And hopefully by now you should have a pretty clear understanding towards price deviations and why they can be so strong. Once you know what you're looking for in these price action patterns, they sort of happen everywhere and you will just spot them. It happens on all time frames, and you know it's important to focus on the higher time frame at all times, but that does not stop you from trading the internal structure. Deviations are a great tool to be using in your day-to-day system. They do not take much to learn. It's mostly about identifying when price does not look strong anymore and you may want to put in a reversal. Make sure you're focusing on other confluences, you know, that being order flow, momentum indicators, or whatever tools you may want to be trading with. You know, I shouldn't have to say this, but nothing has 100% hit rate. Most of the examples I showed you here are perfect plays with the stars aligning, but simply for educational purposes, right? Of course, these setups will happen, and if they do, they're an A+ setup. You know, they're a must-take setup. Over time, you'll start to notice what works and what doesn't. It's up to you to identify that. You know, deviation reclaims can fail just like everything else. End of the day, it's active participants in the market to decide what happens in the market, you know? And that sums up episode 5, part 5. So part 6 of MSM, we're getting there now. Bear with me, almost at the finish line. I suggest that if you still aren't taking much of it in, you go back and you watch this episode yourself again, or you read it. I'll post the link to the presentation so you can go through it, but there's a lot to take in, and I'm only scanning it, otherwise it's going to be like a 2-hour episode. So we're going to be talking about Monday range, what it is, finding strong and weak performers for the coming week, and trade examples. Monday range, a tool I learned from Rec Proof a while back, and the first place I ever saw it mentioned was by him, so all credit is due there with regards to this helpful trading tool. I have no credit for this. The Monday range is formed of the highest and lowest traded price of the day, that being Monday. It marks a high and low for us from the wicks. Majority of the time we can use this high and low as a significant price point for the week ahead of our trading. Is a tool that can be used to help find potential outperformers early for the week ahead. Okay, so it's very important to understand that the Monday range is only valid past daily close and the start to Tuesday's trading day session. Do not attempt to use it before the Monday session has closed out. So this is it: highest traded point on the Monday, lowest traded point on the Monday. So that's our Monday low, that's our Monday high. As soon as Tuesday's session starts, we can start using the Monday range. This is when it can come into play. So using it to find strong versus weak performers, it's good to use to find potential trades for intraday and week side of things. It's a tool I like to use for both reversals and continuation of price action. Rather than me sitting and rambling about how it can work, I'm going to write a quick list of the different ways we can use Monday range. So the first one is a bullish reversal setup. If price sweeps Monday low, we can look for a reversal towards Monday high. Bearish reversal setup. If price sweeps Monday high, we can look for a reversal towards Monday low. If price breaks Monday low and accepts below there, likely it's going to see downside for the week. Bearish setup. Bullish setup. If price breaks above Monday high and holds above there, likely that asset can be bullish for the week to come, right? So bullish reversal setup. You can see here Monday low, Monday high, price breaks down below Monday low, deviates back above Monday low, reclaims, trades to Monday high, right? Monday high to here, Monday low to here. Price sweeps Monday high on a day after the Monday range, breaks back inside, trades towards Monday low. Okay, bearish reversal setup. Bullish continuation setup. Price breaks Monday high on the Tuesday afternoon, trades higher for a couple of days, holds above the Monday high and gives a solid reaction. Focus on this asset for the week, right? This is something you want to be focusing on, something that's trading above Monday high already. You want to look at that, continuing to trade that for the long side. Bearish, and you can see for that week we've done like a 14% move. Bearish continuation. Price breaks Monday low. On the retest, it fails to reclaim, and we get a break of structure here, and then price continues to trade for a week. Since retesting Monday low, it does a 16% move to the downside, right? Just with everything I've been talking about in today's episode, try to add other confluences to these concepts rather than just having one strict rule, such as reclaim Monday low, I must long here. It's important to have other confluences. Everything I've been covering today goes hand in hand with each other, and you will notice how well everything puzzles and slots together. I use most of these concepts together in my own trading methods. It's just a matter of you putting them together now and having the time and effort to mirror it into your own trading system. Here's the indicator I recommend you use, and that sums it up for part 6, Monday range. We're getting there. Final part 7. We're going to be talking about momentum tools and how you can use these in confluence with market structure and the concepts we've been going over. Mostly you're going to be talking about divergences. When I'm talking about momentum oscillators here, I am talking about the divergences that are being formed using them, and understanding momentum divergences and using them in confluence with reversals is a great combination of tools. Just like everything else I've been covering in the episode, is another tool in which you can choose to use or not. But either way, it goes hand in hand with the topics I've covered today. Even with using divs, it's not something you should be using blindly. You shouldn't be shorting because we have bought a bearish div, or you shouldn't be longing just because you have a bullish div. It's not how it works, right? Understanding market structure is very important with divergences as well. They have a good confluence together. You know, momentum oscillators are great tools for finding tops and bottoms when the market is exhausting in that current move. We spoke on finding exhaustion using market structure already, so using divergences is an added bonus. There's only two specific divs that I will look for on momentum indicators. The bullish div is when price makes a lower low and the oscillator makes a higher low, and a bearish div is when price makes a higher high and the oscillator makes a lower low. What this is showing us is that there's an exhaustion in sellers, and then what this is showing us is that there's an exhaustion in buyers. Bearish divs at tops, bullish divs at bottoms, right? A bullish div, there's potential for having a multiple div, so we could see something in the likes of this form, and then like that, so we have like a triple div. Okay, so this is why it's important to use market structure to focus on not just longing a divergence randomly. You want to be longing with the market structure shift as well. And also, personally, I use the divs to the bodies of the candles, not wicks. Personal preference, backtest it yourself, but again, wicks are noise in my opinion. So we can see RSI divs here. Oscillator makes a lower high, price makes a higher high, we sell off. Oscillator makes a higher low, price makes a lower low, we pump. Right, important to wait for market structures triggers. We have a div here, but then nothing comes of it, right? We just SFP this high. We don't get a structure break and we continue lower. Okay, eventually here we have this triple div that I was on about, and then we get like a market structure break, right? And then we can look to trade higher. Awesome oscillator divs. So this is the awesome oscillator. We can see a triple oscillator div. Actually, it's in the same thing here, right? So here we had the confluence of two different oscillator divs matching, and you see the move we get here: higher high, lower high on the oscillator, sell off, right? Higher low, lower low. Also on this we have the confluence of having an RSI higher low as well, and then you see how price extends higher, right? So not entirely here to talk about divergences and how to use them. There's loads of educational content out there on this. Mostly just want to show you the use they have with our market structure concepts. RSI and awesome oscillator go hand in hand and will show a similar divergence. But sometimes awesome oscillator can be a hit or miss. So I recommend starting off with RSI only, and then eventually implement awesome oscillator into your system once you have back tested and understood how it works, because it's, like I said, it's sometimes a bit hit or miss. So using market structure with oscillators, I'm going to blast through this. I don't want to ramble on too much, but you can see here price makes head and shoulders, but also we have this divergence on the oscillators, so where price is making a higher high, oscillators are making lower highs. This is a sign of divergence. It gives you more reason to be taking this short here, because we have a divergence at the top. It's telling us that buyers are exhausting here, right? Momentum is dropping, buyers are exhausting. Then when we look to trade lower, right? Here, same thing again. Price attempts to trade above our structured high. On the break above, we get this divergence, right? Price makes a lower high, awesome oscillator makes a lower high, and price makes a higher high, right? Again, buyers are exhausting. We get the change of structure here as well, and the over under, right? And this is why it's very nice to have, you don't have to have these on your chart. You can have them hidden. If you double click, you can hide your indicators on TradingView. But exhaustion on the attempt of breaking above the previous structured high, div showed on awesome oscillator. And here we can see an example. This is the H4 chart here, and this is the M30. You can see you know, of that was of the previous Litecoin chart. We had the divergence here, but also on the H4 chart, we could see the higher high on the H4 chart had a large divergence, right? So not only do we have a divergence on the lower time frame, we zoomed out, we looked at the higher time frame, we also see that the higher time frame has a divergence, and look at the drop we see. I think this is on Litecoin, right? That's probably around a 10% drop at least, just because we have low time frame trigger and a high time frame divergence, right? And that sums it up for our last section. So part 8, our conclusion and our homework, right? This is it now. The episode is coming to a close, right? To wrap this all up, hopefully you're coming away learning something new from this episode. Whether you already know of these concepts or you were completely unknown to it, I appreciate you coming this far if you did. There's a lot to take in, and I know it can be overwhelming at first, but I'm sure in one way or another, these areas I covered today should concrete your knowledge into understanding strong versus weak structure. You know, this was the whole point of the episode. Mostly identifying reversal setups, identifying when structure is becoming weak, when structure is becoming strong, and you know that was the aim for the episode. So if you are getting up to scratch on this, then I have achieved something. I really did spend a lot of time for perfecting this episode and writing it up and trying to make it as easy to follow as possible. Also utilizing your time spent reading and watching. It actually turned out to be a bit longer than I anticipated, but it is what it is. I don't think I could have shortened it anymore. You know, all the information I put in here, in my opinion, was valuable information. It stops people leaving the episode and being unfulfilled or not knowing. I wanted to really make sure that everything was ticked for this episode. So if it takes my time doing it, but also your time following. So if you come away thinking it was time well spent, then again, I've done my job. If you want to support my work, you can sign up to Bybit following my link here, and also drop me a follow on Twitter if you have not already. And as always, I have some homework for people within my MSM class. This is the homework I want you to look at. Feel free, even if you're not in the MSM classes, to do this and send it my way. If you want to be involved in my MSM classes, then obviously drop me a message. I'm happy to add you in. And that is the end of episode 5 of MSM. Really happy to get this finished and uploaded. Appreciate everyone for getting this far, and I will catch you all in the next one. Cheers.